You're listening to AI Prism from Seoul Economic Daily.
It's Thursday, May 21. I'd like to share some thoughts about markets daily. So, foreign investors just dumped 94 trillion won, which is roughly 67 billion US dollars in Korean equities this year. But despite that massive sell-off, they somehow own a record-breaking 39.33% of the KOSPI, Korea's main stock index. Today, we're doing a deep dive into some fresh reporting from Seoul Economic Daily to figure out how that math actually works and explore this central paradox for you today.
It's a really fascinating contradiction, honestly. I mean, Korea's weight in the MSCI Emerging Markets Index just hit 21%. They're trailing China by less than a single percentage point now.
Oh, wow. That close.
Yeah, that close. And that record foreign ownership in the KOSPI, it's not some strategic play. It's actually just a mechanical lag.
Right. It's like trying to bail water out of a boat, but the boat keeps magically expanding.
Exactly. Because even though foreign funds are throwing billions overboard, the sheer velocity of the tech sector, specifically AI and memory chip giants like Samsung Electronics and SK Hynix, well, it means the total market cap is growing much faster than they can sell.
So the remaining slice of the pie actually got bigger.
Right. The math is just overwhelming. And the sheer scale of this tech rally is why Hana Securities is now projecting a greater than 60% probability that Korea finally gets added to the MSCI Developed Markets watch list this June.
But if we look past those semiconductor giants, the broader market is still heavily tethered. That tech surge is kind of hiding what's known as the value trap.
Yeah, and we track that using the price-to-book ratio, or PBR. This basically compares a company's market value to the raw value of its physical assets and cash.
Right.
And right now, 1,256 listed companies in Korea are trading below a 1.0x PBR, which is actually an increase of 12 companies since the government's presidential roundtable on this issue back in March.
The sources highlighted a specific paradox here with a company called SG&G to show how stubborn this discount is. Their stock price surged nearly 90% recently, but their PBR actually dropped. Wait, so if the stock almost doubled, but the PBR went down, that must mean their hidden asset value is growing at a staggering rate, right? Completely unrecognized by the market.
Spot on. The underlying book value expanded even faster than that surging market price. I mean, the broader market just refuses to value those assets at full price.
So how do we fix that?
Well, keep an eye on July. The Financial Services Commission, the FSC, is going to publish a definitive list naming these underperforming companies. They're slapping a visible low PBR label right on their stock tickers for you to see.
But why is the market discounting that book value so heavily in the first place? It really comes down to corporate governance, specifically this practice called jonbok sangjang, or dual listing.
Yeah, this is where a parent company spins off a profitable subsidiary and lists it separately on the Korea Exchange.
Which instantly dilutes the value for the parent company's original shareholders, right?
Exactly. And the big debate now is how to require shareholder consent before these spin-offs can even happen.
And the most aggressive proposal targets the chaebol, a massive family-run conglomerates that dominate the economy. It's called majority of minority, or mom voting, which excludes controlling shareholders.
Right.
But let me push back on that for a second. Given the historically abysmal voter turnout among Korean retail investors, wouldn't requiring a majority of minority votes make passing any resolution nearly impossible?
That is the exact friction point. I mean, if you remove the controlling family's votes and retail investors just stay home, you effectively hand absolute veto power to foreign institutional funds.
Because they actually vote.
Yeah, they vote and they count as minority shareholders.
Yeah.
So it would be a massive shift in market power over these chaebol spinoffs.
So while equities debate these future governance rules, the real estate sector is facing this immediate real-world liquidity crisis. JR REIT recently filed for overseas receivership, and it's sending funding costs across the entire sector up to 5%.
It's a textbook confidence shock. When one major player hits receivership and defaults, lenders just panic.
Naturally.
They start wondering who else is holding bad assets, so they immediately tighten credit for everyone. They demand higher yield for the perceived risk.
Which brings us to the bellwether everyone is watching right now, which is Lotte REIT.
Right.
They're sitting on the sidelines with 395 billion won, about 282 million US dollars, in bonds maturing between August and October. If lenders refuse to roll over that debt or force them to borrow at those new 5% rates just to survive, that bleeds their profitability, right?
It certainly does. It signals deep stress across the entire listed REIT sector.
Yeah.
So if we connect all these dots, it leaves you with a critical question to consider. Will that looming June MSCI decision force the government to take quicker, decisive action on shareholder reforms?
Or will it take the pressure off?
Exactly. Will the momentum of simply getting on the watch list relieve the pressure to fix these underlying structural discounts? Something for you to keep an eye on.
That's today's AI Prism, Markets Daily. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI Prism is a Juan Ifra award-winning series. We'll be back tomorrow.
You've been listening to AI Prism from Seoul Economic Daily.